Hello, everybody. We're beginning to start our town hall. We've got Tim Pierotti on. He's our chief investment strategist, and he's just going to kind of give a 15-minute overview on what's going on in the markets, and then after that, we'll open it up for some Q&A. So, without ado, Tim, let's begin.
Awesome. Thank you, Drew. Yeah, so I'm going to take like 15 or 20 minutes, and what I'm going to do is I'm going to talk about the current cycle. And then I'm going to talk about our long-term thesis. And our long-term thesis is really unchanged for the year and change that I've been with WealthVest. First of all, when we talk about the current cycle, I use the construct HOPE, H-O-P-E. I'm not the only one who uses it. It makes a lot of sense, and it allows me to really talk about everything that's going on. And HOPE is housing, orders, and when I talk about orders, I mean manufacturing. P is profits and the profit cycle. And then E is employment. Housing orders, housing and manufacturing tend to be leading economic indicators. Not so much this time. Profits are the ultimate coincident indicator, and then employment lags, as I think everybody knows. And then with that, and then that kind of leads me into kind of where we are with this long-term thesis. And to bury the lead, the long-term thesis is unchanged, and it's that we have a long-term secular inflation problem. And the issues that are driving that inflation primarily is labor more than anything. We have a labor shortage, and we have a labor shortage that outside of a recession isn't going away. We also are going to have the energy transition and the inflationary forces that brings via underinvestment and demand for critical minerals where there is underinvestment. And then lastly, just the debt and deficit issues. That has been a focus lately. I've written a couple pieces about it recently. That's inflationary. We have a problem. And you can really see that in the markets right now, as you see basically the long end of the curve at 10 years trading in lockstep with equities. When you see the 10-year yield start to move up towards that 420, you see equities roll over and vice versa. So anyway, let's start with the current cycle. And we start with housing. And the reason it makes sense to start with housing is so damn important, right? It dictated the last cycle in the opposite way that it's dictated this cycle. So in the great financial crisis, it was all about housing. It was all about the huge credit growth that drove this huge housing bubble, and then housing imploded. Well, the opposite, in a sense, has happened this time. The Fed has started raising rates, but there's no credit sensitivity. And I'll get through this quickly because I think everybody kind of understands this. Everybody has kind of heard about this golden handcuffs phenomenon. Well, why are housing prices going up when the 10-year, when 30-year mortgages have gone to over 7%? And it's because of supply. Supply is down somewhere in the order of 30% year over year. There is, and then the other part of it, because nobody can move, right? If you got a loan at 3%, you're not giving that up in order to move. You can't live anywhere cheaper than where you're currently living. And there's really no telling in what changes that. There's a lot of older people. There's a lot of baby boomers living alone in houses. They don't have mortgages. Those people over time will move, but there's no catalyst to get those people to move. Very often, they don't even have mortgages anyway. But housing is really held up so much better. And that is the number one thing that has kept this cycle strong. And it's one of the reasons why, and I'll get to employment at the end, but it's one of the reasons why employment has stayed so strong. In the great financial crisis, the vast majority of workers that lost their jobs were in housing and manufacturing. Getting flashes here. And that just isn't happening in this cycle. Will it happen? Look, housing is softening. Overall investment is down. Purchase apps yesterday were down 27%. So when you look at residential investment, it's not just new purchases, but it's also upgrading houses and so on and so forth. And you see it with the weakness at the Home Depots and the Lowe's. People generally who are staying in their house aren't investing as much money in their houses. And it is a drag on GDP, but it's not a huge drag, and it's not like it has been in previous cycles. And there's a wealth effect to it, right? People feel good about their finances when they feel good about the value of their house. All of that is basically the opposite of the last cycle. Manufacturing is the opposite. Manufacturing is in a recession. with two very important exceptions to that. Manufacturing construction. The construction of manufacturing facilities is normally about 1% of GDP. In this cycle, in the first half of the year, it's been 20% of GDP. What you have is the fiscal spending, the kind of the, people talk about the long and variable lags to monetary policy slowing or stimulating the economy. The same is true for fiscal policy. When you're running $2 trillion deficits, that's going to have an impact on spending. And where you're seeing it is in a lot of ways is in manufacturing construction. It's building fabs, it's building battery facilities and all of the electrical components around the sort of the energy transition, and also the protectionism that is happening in order to rebuild semiconductor manufacturing in this country. This is annoying. So that is offsetting a lot of the weakness in monetary policy. It is stimulating demand. It's called fiscal dominance, and it is very clearly happening. You can see it best in the manufacturing sector. One of the other things that's happened is autos. Now, you're finally starting to see autos and auto prices start to roll over. Used car prices have started to roll pretty hard in Manheim. You saw that in the CPI print today. Used car prices were a big drag. You are finally getting to full inventories in the auto side. You had a lot of pent-up demand for a long time. I think that was keeping durable goods purchasing higher than it otherwise would have been. That has started to soften a little bit. So you are starting to see, we had all of these ISMs that were really, really weak. It was clear that manufacturing was in a recession, but it's not quite big enough all by itself to bring down the economy, especially when housing stays as strong as it is. Let's look at the profit cycle. All right, equities keep going up, and yet earnings keep going down. Earnings aren't going down precipitously outside of oil and materials, which carried Q1, which are now weak in Q2. Profit estimates are about flattish. The economy really hasn't gone into recession yet. It has been surprising to me how well equities have held up when profits continue to weaken. Profits are going to be correlated to nominal GDP growth. Nominal GDP growth is slowing. Look, with all the crazy stimulus that we had in the pandemic, we had quarters, I think in early 2021, where we had 20% nominal demand growth. We don't have anything like that now, but it is coming off such a high level that it takes a long time for it to peter out. But it is starting to peter out. If you look at Redbook, which is same-store sales across 80% of retail, they're coming off these huge high numbers from 21, and they're getting to around flattish. You actually ticked into some negative numbers. Consumption is slowing, but it is slowing more slowly than the Fed or most people would have guessed. And then that brings us to employment. Employment has held up better than most would have guessed, but it is starting to soften. You are starting to see some weakness. You see weakness in the leading indicators of employment, like temp job demand. Recruiting, you had a company called ZipRecruiter that reported on Monday that said that their engagements in July, so not within their last quarter, but giving some forward-looking outlook, was down 31%. So what you have is this kind of this stasis that has occurred within employment. The National Federation of Independent Businesses, they look at the small businesses. They're looking at it and saying that you have this weird duality in labor where 45% of companies have positions that are unfilled, and yet those companies aren't really looking to fill them because they are concerned. So small business optimism is still not strong. Small business optimism is kind of ticked up in sentiment, soft surveys, but the real data, their hiring, isn't very strong, to the point where the chief economist at the NFIB kind of called into question what's happening with the non-farm payrolls. How are these numbers so strong? Now, payrolls are starting to weaken. The kind of the rate of change is slowing. We're adding a couple 100,000 jobs now versus in the previous 3 months, it was more like 300, and before that, 400. So it is slowing. You're starting to see jobless claims start to tick up. You saw jobless claims pick up again this morning. It's just happening very slowly, and it takes me all the way back to housing. One of the reasons, and I think the key reason, is housing. Housing employment matters. I do think that as you get a huge amount of completions, and you have a huge amount of completions in multifamily where vacancies are already starting to tick higher, you are going to see some multifamily weakness, and you will then see some weakness on the employment side as you get to all these completions and vacancies are higher in multifamily. So that's kind of the cyclical outlook. I think that's what we're looking at right now. And I would just describe it as, the optimism of the market has been driven by the idea that growth has been stickier than inflation. And I think the risk, and I think one of the reasons why you're seeing some weakness in equities right now is the concern that maybe growth is going to kind of keep coming in while inflation is going to kind of level out. And you saw that in today's CPI. You saw the CPI actually tick higher from the June reading, and there is fear that that could continue to happen. There are very powerful forces on either side of that. Residential, housing, owner's equivalent rent, whatever you want to call it, that is going to keep softening, and that is a big piece of inflation. But on the other hand, medical costs, and that really is about really stupid statistical quirks, but medical costs is going to start going up in the CPI. Energy is going to start going up in the CPI. The fact is you have won the fight on goods inflation. The Fed has won that fight. It's over. A lot of that was transitory. Service inflation, where it's so much driven by wages, that fight has not been won. As a matter of fact, the most recent Atlanta Fed estimate on wages ticked up in the past month. You're still running about 6% labor increases. Well, you are seeing that then in profits. Companies have to preserve margins. You will see employment move up when margins move down more. There's labor hoarding right now. People are afraid to lay off people. But when margins really start to hit the owner, when the owner's lifestyle of that business, large or small, becomes impacted, you will see meaningful layoffs. Now, what is different about this cycle? Because remember, coming into this cycle, guys like Larry Summers, and there was a bunch of big academic studies that suggested to get inflation down, you were going to need to run unemployment up to like 6%, 6.5%. Well, that's what history would have told you. History, though, doesn't contemplate the reality that we are in a new world. And that new world is going to be driven by the labor shortages, developed world labor shortages. And that is mostly all about demographics and protectionism. The biggest piece being demographics, right? Peak of the baby boom was 1957. You're turning 66 this year. The biggest weakness in the labor market, 24, 25 to 54-year-olds are working at the same rate and at the highest rate that they have since like 2010, almost quite, not quite where we were, but we're getting there. We're at pretty full employment, but it's those over 55s, it's those over 60s who we've relied on in this labor market that have started to come, that have really in real way come out of the labor market. And then the fact is we got low fertility rates. We have very few, we don't have enough people to replace those 55 and overs to come into the labor market, and they're not as productive when they come in. That is a story told all over the world. We have a demographic issue. The demographic issue in developed Asia is worse, and and it is also worse in Europe. What could change that? We could have a lot more immigration, but that's probably not going to happen. It's just not politically viable to have much more immigration that is going to overcome the labor shortages that we have. Also exacerbating it is protectionism, right? All of these manufacturing facilities that I talked about that we're building, TSMC just came out the other day and said, we can't build this damn thing unless we bring in 500 engineers from Taiwan. Well, what happens? The labor unions out in Arizona goes, you're not bringing in 500 workers here. No chance. So you do have this push-pull battle. You have a lot of labor, right? You have a lot of labor pressure, and you're seeing it. The UPS just got a 48% increase over 5 years for their workers. The UAW is starting their labor negotiations where they're not even shaking hands. They are making it very clear that they are in for a war. Why? Because the jobs aren't getting shipped out to China. That game is over. And labor is empowered now. And you are going to continue to see pressure on labor. That makes the job of the Fed really very, very difficult. In a service economy where wages are everything and your cost structure, wage pressure is hard to overcome. Overcoming the issues of the pandemic and supply chain issues, that was easy to overcome. Overcoming labor without taking unemployment higher just isn't going to happen. So the Fed has to keep going. Now, that doesn't mean the Fed has to keep increasing interest rates. They can just go sideways. Rates affect people over different junctures of time. Like I said, with housing, everybody termed out their debt. I got a 30-year mortgage. I'm not going anywhere. It's a story told a million times over. Same thing with corporates. If you were a corporate treasurer over, from 16, 17, 18, and you weren't terming out your debt, that's kind of malpractice as a CFO or a treasurer. So the sensitivity to all the rate hikes has taken longer in this cycle to really impact the economy. But you don't have credit statistics looking like they're looking in terms of demand falling and credit tightening without it stimulating, without it dragging down nominal growth. That is happening. The other issue, why I believe we have secular inflation, and by the way, this is becoming kind of a consensus view. KKR wrote about it. BlackRock just wrote about it. This idea that we have a labor shortage and we have an energy transition. And the energy transition, the problem there is that the energy transition is coming at a time when investors are very adamant, when the big investors, the big mutual funds of the world are saying to companies from ExxonMobil to Freeport-McMoRan, give me the cash back, okay? We're going through an energy transition. People are going to use less oil. Well, the energy transition is going to take a long, long time. And along the way, we are underinvesting in resources. We're underinvesting in oil resources, but critically important is the critical mineral underinvestment. And that's why people with this thesis are so excited about copper and the things. An electric car requires so much more of these critical minerals: nickel, aluminum, copper, cobalt, lithium, graphite, than a conventional car. So does solar. So does wind. That is making people feel like post a long periods of competitive devaluation, commodities day in the sun is here, and it will be, and it really you might best see that in those critical minerals that are critical to the energy transition. And then the last piece of it, and I mentioned it before, is we have structural budget deficits. We have $2 trillion deficits at a time when unemployment is at 3.5%. When you get unemployment down to 3.5%, you should be pretty damn close to surpluses. Well, we're nowhere close to a surplus, and the risk is that we continue to borrow money. And what you're seeing is when you borrow, when Treasury just came out the other day, Yellen came out the other day and said, all right, we're going to have to start borrowing some money at the longer end. We're borrowing at 5% on the short end. Not great. You can borrow 4% on the long end. Why don't we borrow some more money on the long end? The problem is, where's the demand on the long end? We have this little intraday sell-off in equities. That was because the 30-year auction was sloppy, and you saw 30-year yields go up, 10-year yields go up, and you saw equities go down. Long end of bonds and equities are super, super correlated right now. And as long as we're worried about inflation, I say it every time, and I'll conclude with this, and then we'll take questions. Bonds don't hedge stocks when stocks are going down out of inflation fears. Well, when you have real fear of way too much Treasury supply at the long end of the curve, and that's taking rates up, and that's taking inflation expectations up, you start to see the weakness in equities.
Hello, everybody. So sorry that we got disconnected today. I promised that we would kind of respond to these questions you asked during our town hall, and that's what we're going to do. So we're going to go through the unanswered questions one by one, and then we're going to send this recording to you. So, Tim, we got through one question. The second question was, how do you feel about the market in the next 3 months?
Yeah. And I started to answer that when we got disconnected. But I think the key is the 10-year. I think if you see some of these auctions continue to be sloppy, I mean, the equities right now are totally correlated with the long end bonds. You had a sloppy 30-year auction today, and that's when you saw equities start to roll over. Equities were up more than 1%. And as we speak now at 345, they are red. And that is all entirely due to that one sloppy auction. Look, the 5 years, which is a measure of future inflation expectations, are starting to move to new highs. We got a lot of supply of long-term debt coming, and I think there's just going to be pressure on the long end of the curve. And if there's pressure on the long end of the curve, I think there's going to be pressure on equities. Nominal growth is slowing. Earnings are slowing. So I think the risk reward is not great for equities.
Great. We had another question come in through the Q&A that was for you to answer the two poll questions that were asked, which at the time were, will the United States experience a hard landing, soft landing, or no correction over the next year? And the second being, will the S&P appreciate, depreciate, or stay more or less flat?
Yeah. I think I'll take the last one first. I think there's downside risk to the S&P. I think that we're very expensive. I think there's still risk to kind of the 215 number for S&P earnings. And as inflation expectations move higher, so should long duration assets like tech. So I don't like the indices, but I do think that there is value underneath. I think there's value in energy. I think there's value in materials. I think there's value in small caps and mid caps. But I don't love owning the indices here. The first question, the first part of that, Drew, was what?
The first part was asking, whether there would be a hard landing, soft landing, or no correction.
Yeah, I think that we do end up putting up some negative GDP numbers, and I think that will come with job losses. I think we'll have to see some negative non-farm payrolls. The Fed has got to win, and the only way the Fed can win is if they get labor prices and the labor market down. The way they do that is continue to keep interest rates high and squeeze corporate profitability, and then you get a little bit of a hard landing. I don't know how hard of a landing it needs to be. I think that labor markets will stay relatively tight. But you do have to have some kind of weakness in the labor markets in order to get inflation to where they want to get it to. And I don't think you can do that without there being a bit of a hard landing. I don't think there necessarily has to be a deep, terrible recession. My bigger concern is the shape of the curve, the shape of the recovery. And I tend to think that we'll have a shallow recession, but a shallow recovery. And we're going to be looking at an extended period of very low growth with inflation volatility.
We have a question as it pertains to the commodity markets. Is there any other place to go in the commodity markets to invest in these minerals? Example, giving people who sold pickaxes during the gold rush probably did a lot better than the panners.
Yeah, I mean, I don't want to get into individual name. The argument would be, should you own mining stocks and so forth? The issue is that you don't have massive resource growth. So buying the services companies or the companies that manufacture, drag lines and all the things that you mine with, might be a tough thing. I think I'd rather be long the commodities themselves, and be long the companies that are generating a whole lot of free cash flow. There's a lot of energy companies out there that are going to give you 20% free cash flow yields for a really, really long time. They are cheap and they're going to return that cash flow to you, and oil just isn't going away anytime soon.
And then the last question we got is that as part of the HOPE analysis, any thoughts regarding the direction of corporate profits for Q3 and Q4?
Yeah, I think that you will continue to see lower revisions because you see lower nominal growth. As nominal growth continues to slow, and it is continuing to slow, I think you will continue to see negative revisions to Q3 and Q4 growth.
Awesome. Thanks for your time today, Tim.
All right. Apologies, everybody. Look forward to doing this again soon.